Hi, thanks for joining us on Rick on Real Estate. I'm Rick Van Wieren at Remax Properties, and my special guest today here is John Haney from Colorado Mortgage Company. And we are going to talk about the myth of mortgage insurance today. I deal with a lot of young buyers, and a lot of these buyers are getting information from their parents and sometimes their parents' parents about how things might have been 20, 30 years ago. And the world has changed a lot, and one of the things that I've asked John to join me here on is to talk about how mortgage insurance can actually be a bridge from getting into a house in the current market at the current prices and current interest rates versus waiting and losing money both from appreciation as well as paying rent while you're waiting and having higher interest rates down the road anyway. So John, thanks for joining me, and tell us a little bit about mortgage insurance and how it all works.
Well, first I'd like to say mortgage insurance is not a bad word. It's not a four-letter word. There's way too many vowels and syllables in there, right? So mortgage insurance is just a tool for somebody to get into a home that has less than 20% down. You know, the old idea that you have to have 20% to put down on a house to avoid the evil mortgage insurance, you know, it's all fine and great. If you've got the 20%, chances are putting 20% down is going to make sense. However, if you're in a position where you're deciding whether to wait to buy a house because you don't have enough saved to avoid that mortgage insurance, well, you have to look at the cost of waiting. You know, we have interest rates that are rising. We've got home values that are rising. Those two combined, just waiting 6 months or a year, may cost you an additional $8,000 to $20,000 that you could be giving up in appreciation and money you're paying in rent currently. So mortgage insurance is just a tool, and that's the way we have to look at it. Is okay, if we're going to have mortgage insurance on this loan, that's just the price we pay for getting into a house, but that's going to be way better off than not getting into a house.
Yeah, that makes sense. So what kind of down payment requirements are there? I mean, you mentioned 20%, and that's kind of the gold standard, obviously, where you get rid of mortgage insurance completely. But, you know, I've heard of programs that go 3%, 5%, 10%. Sure. How does all that work? And is mortgage insurance less the more you put down, or?
Yeah, so there's a matrix that we are going to look at for every scenario. Number one, credit score drives the train. Now, there's different types of mortgage insurance that are going to be required for conventional loans or FHA loans and USDA loans. So there's different mortgage insurance for different types of loan products. But let's just talk about conventional. This matrix that we're going to be using to determine the cost of mortgage insurance, it's not a myth. It's pretty plain and simple. What's your credit score? What's your property type? What's your occupancy? You know, we're going to go through about 12 different pieces to figure out what your factor is. And the mortgage insurance is actually, in some cases, if you're doing a 3% down loan, may actually be lower than if you put 5% down.
Really?
Yeah, believe it or not, there are some special programs for first-time home buyers. Fannie Mae and Freddie Mac have Home Ready and Home Possible programs that offer a lower cost of MI for that first-time home buyer versus somebody who's only putting 5% down who's purchasing their second or third home.
Interesting.
And so the mortgage insurance can vary widely, but let's just say on average, if you've got a great credit score, let's say 720 or higher, and you're putting 3% down, you can expect to have a mortgage insurance factor of about 0.5%, give or take, you know, 0.25% one way or the other, depending on those other factors in the matrix. So you figure if your cost of borrowing today is 4.75% on a 30-year fixed, add another 0.5% onto that for your mortgage insurance, and that's at least going to give you a little bit, it's going to get you close on what your total principal and interest and mortgage insurance payment would be.
Now, mortgage insurance isn't a permanent thing either, is it?
That's right. Yeah, and there's a couple of different ways to slice mortgage insurance. Lately, lenders have gotten really good at advertising no mortgage insurance, and it sounds sexy. Oh boy, and guess what? We can offer that. We can offer a loan with 3% down and no mortgage insurance, but you know there's no such thing as a free lunch. They're getting that somewhere. And typically what they're going to do is they're going to raise your interest rate, and the lender's going to pay your mortgage insurance for you. So you're still paying for it. It's just that you're going to be stuck with that mortgage insurance forever if you do a lender-paid mortgage insurance option.
Because it's already been built into
That's right.
the rate.
It's built into the rate.
Permanent.
And that rate's set for 30 years.
Gotcha.
So the other option is borrower-paid mortgage insurance, where the rules state that once you've reached your 80% loan to value, your home value's gone up, your mortgage balance has gone down, or maybe you make home improvements, or there's other things that you can do to get out of your mortgage insurance so you're not stuck with it for life.
So my clients who might have bought under those terms, say 4 years ago, could very well be in a position right now where that mortgage insurance could go away.
Absolutely.
If we can prove that they're 80% vested in their property.
Absolutely.
And by the way, if you think you're in that position, I'd love to talk to you about what your house is worth right now, because getting rid of mortgage insurance is like Christmas. I mean, if you're talking 0.5% in terms of mortgage insurance, 0.5% a year on a $300,000 house is what, $1,500?
That's right.
If I'm doing my math right. I do round numbers easy. The extra decimal points I don't always get right. But so when you're talking $1,500 a year, that's more than $100 a month that you could be saving on your house payment if that's the case. So
that's right.
That's a really good point to
mortgage insurance isn't a dirty word, but when it comes time to get rid of it, everybody celebrates.
Yeah, for sure.
But again, the main point is that by the cost of waiting, to try to avoid mortgage insurance, I don't think is necessary in this market. Getting into a house sooner than later has way more benefits than the cost of mortgage insurance, even for a few years.
Right. Well, and that brings up another point for my clients whom I might have sold a house to 4 years ago. They bought those houses at a lot better prices than what we're seeing right now, and they probably are in actually really low interest rates right now. 4 years from now, we could be looking at higher prices and higher interest rates, and your mortgage insurance will be the least of your worries if that's the case. So thanks for talking to us about a great tool to kind of bridge that gap between getting in the current market versus having to wait for a market that may be more expensive and have higher interest rates both. Thanks for joining us on Rick on Real Estate, and thanks for joining me today, John. Appreciate it.